$5,000 gone in one earnings report, and most tech workers don't even see it coming. Here's the hard truth. You've probably been told that semiconductor stocks like Broadcom are recession-proof, that the chip industry is immune to economic cycles, and that tech is always a safe long-term bet. That belief just cost you money, real money, and we're about to prove it. By the end of this video, you'll understand exactly how Broadcom's earnings mistakes could impact your portfolio, what the data actually shows about semiconductor industry risks, and the specific dollar amount you could lose if you don't diversify. We're talking concrete numbers, not speculation. Let's start with the core belief that's failing tech workers right now. You've been told semiconductors are essential. They are immune to downturns. Buy and hold tech. Here's what the Semiconductor Industry Association actually found. The chip industry is heavily dependent on global economic trends. A 15% decline during economic downturns is not rare, it's the pattern. According to the SIA 2022 report, semiconductor companies face direct exposure to consumer demand collapse, supply chain disruption, and enterprise capex freezes. Broadcom is no exception. So here's the delta. You thought you were safe. The data says $1.50, 000 Broadcom position could drop to $42,500 during a moderate downturn. That's $7,500 loss. Over 2 years, factoring in further portfolio erosion, you're looking at potential $10,000 hit on a concentrated tech position. For a tech worker whose retirement depends on disciplined saving, that's life-changing money. Now let's look at what Broadcom's actual earnings report revealed. Broadcom recently guided lower than expected. The company cited 3 specific issues: inventory corrections in the data center, weaker hyperscaler capex, and margin compression from this is critical geopolitical uncertainty. That last one isn't about Broadcom's engineering. It's about tariffs, supply chain risk, and economic policy. It's exactly the kind of macro headwind that the SIA warns hits semiconductor companies hardest. Here's where most investors miss the real risk. Broadcom's 10K filing shows 42% of revenue is tied to data center and networking. That segment is cyclical. When enterprise tech budgets freeze, which happens during recessions, Broadcom gets crushed. The Federal Reserve data on semiconductor orders shows a clear pattern. Every recession since 2000 has triggered a 12-18-month demand collapse in this exact category. Let's talk about your portfolio specifically. If you're a tech worker with $50,000 in Broadcom and another $50,000 in other semiconductor or tech names, you're carrying about 40% sector concentration. Industry best practice: no more than 15-20%. A 10% Broadcom drop costs you $5,000 immediately. A 15% decline, which the SIA data shows is realistic in a downturn, costs you $7,500. Multiply that across your holdings, and you're looking at $15,000 to $20,000 in potential losses from a single sector rotation. But here's what you can actually do. The research shows that diversified portfolios, those with 20-30% tech exposure, not 40-50%, outperform concentrated tech portfolios during downturns by an average of 8-12% annually. That's not theoretical. That's historical S&P performance data from the last 3 recessions. Specific action: review your portfolio tonight. Add up your Broadcom, Nvidia, Intel, AMD, ASML, and other semiconductor holdings as a percentage of your total portfolio. If it's above 25%, you're overexposed. The move: trim positions to 15-20% tech, rotate the proceeds into defensive sectors. Utilities historically outperform in downturns by 300-500 basis points, and maintain cash reserves. For $100,000 portfolio, that could mean the difference between a $10,000 loss and a $2,000 loss in the next downturn. Broadcom's earnings didn't fail. Your portfolio allocation did. The company executed fine. They just revealed that the broader semiconductor cycle is weaker than the market assumed. That's a portfolio problem, not a company problem. The key takeaway: semiconductor stocks are not immune. They're cyclical, they're sensitive to macro policy, and they're vulnerable to 15% corrections during downturns. The SIA data proves it. Broadcom's guidance proves it. Your job is to act on that evidence before the next shock hits. If this changed how you're thinking about your tech concentration, hit subscribe. Next week, I'm breaking down tariff impacts on semiconductor valuations, which sectors get destroyed first and which actually benefit. Ring the bell so you don't miss it. And comment, how much of your portfolio is semiconductor exposure right now? Let's discuss in the thread. Markets reward the patient and the prepared.